Welcome to Charged Alpha's Q1 2026 earnings coverage. Today we're diving into Wintrust Financial, ticker WTFC, a $72 billion community banking powerhouse headquartered just outside Chicago that just delivered its fifth consecutive quarter of record net income.
Fifth consecutive record. That's not a fluke. That's a franchise firing on all cylinders. EPS came in at $3.22 diluted, beating the $2.96 consensus by nearly 9%. Not bad for a bank that most people outside the Midwest have never heard of.
And that's kind of the whole story with Wintrust. It's been quietly building one of the most consistent earnings machines in regional banking, one community at a time.
Today we're going to unpack exactly how they do it, what the numbers look like under the hood, and whether this stock has more room to run.
Wintrust Financial was founded in 1991 with a straightforward thesis that communities deserve a real local bank, not just a branch of a mega bank. The company is headquartered in Rosemont, Illinois, right on the edge of Chicago O'Hare, and today operates 173 banking facilities spread across the Chicago Metro, southern Wisconsin, northwest Indiana, and parts of Florida.
The business model is what sets them apart. Rather than one monolithic Wintrust brand, the company operates through a network of separately branded community banks: Northbrook Bank, Lake Forest Bank, Hinsdale Bank, and so on. Each bank has its own leadership with deep local roots, but they all share Wintrust's balance sheet and back-office infrastructure.
So you get the feel of a neighborhood bank with the lending capacity of a $72 billion institution. It's a genuinely rare combination.
Revenue comes from two main sources. First is net interest income, the spread between what they earn on loans and what they pay on deposits. NII was $579 million in Q1 2026. Second is non-interest income, wealth management fees, mortgage banking, service charges, which added $134 million last quarter.
Total net revenue for the quarter came to $713 million. And for context, NII has been growing every quarter for the past year, from $526 million in Q1 2025 to $579 million in Q1 2026. That's a 10% increase year over year from the core banking engine.
The bank serves about 5,900 employees and lends primarily to middle-market commercial clients, small businesses, and individuals across the greater Chicagoland area. Think the dentist's office on Oak Street, the distribution company in the suburbs, the family that's been banking with Lake Forest Bank for 3 generations.
Commercial and industrial loans, commercial real estate, residential mortgages, home equity, those are the bread and butter, and they've been growing the loan book by roughly $1 billion a quarter.
The key thing to understand about Wintrust's moat is that this model is very hard to replicate. A JP Morgan or a Bank of America can offer better app features or more branches globally, but they cannot offer a local banker who knows every business on the block. That relationship banking generates sticky deposits and loan demand that national banks consistently struggle to match.
Leading all of this is Timothy S. Crane, who became president and CEO on May 1st, 2023, though he'd been president since February 2020 and joined Wintrust all the way back in 2008. So this is a company lifer who has watched this bank grow from roughly $20 billion to over $72 billion in assets.
Before Wintrust, Crane spent 24 years at Bank of Montreal and its U.S. subsidiary Harris Bank, ultimately serving as president of Harris Bancorp, which was BMO's entire U.S. banking operation. He knows large-scale regional banking from both sides of the CEO chair.
Education-wise, MBA in finance from the University of Chicago, fitting for a Chicago banker, and an undergraduate degree from the University of Illinois at Champaign-Urbana. He's also done executive programs at Ivy Business School and Northwestern Kellogg.
Wall Street's take is generally positive. Most of the street maintains buy ratings on WTFC, which is a quiet endorsement of Crane's execution track record. Truist cut its price target in March 2026 from $170 to $150, but that was a sector-wide valuation reset, not a criticism of management.
Let's dig into the financials. Lana, how does this look?
Start with valuation. At a $148.79, Wintrust trades at 12.1 times trailing earnings. That's the cheapest it looks on this metric compared to the broader regional bank peer group. Price to book is 1.37. And here's an interesting data point. The Graham number for WTFC is $173.21 on, which means the stock is currently trading below its intrinsic value estimate by Benjamin Graham's classic formula. That's relatively rare.
So on pure valuation math, this doesn't look expensive.
Not at all. Forward PE is about 12 times the 2026 consensus. The street expects $12.44 this year. The stock yields 0.71% on dividends and has a beta of 0.855, meaning it moves a bit less than the overall market. For a bank focused on steady compounding, that makes sense.
Now let's talk about what actually happened in Q1 2026.
Net interest income was $579 million. That's down just slightly from Q4 2025's $583.9 million, but up 10% from Q1 a year ago. The net interest margin came in at 3.56% on a fully taxable equivalent basis, up 4 basis points from Q4. So despite a modest sequential NII dip, driven by a slightly shorter quarter, the margin itself is still expanding.
Is that meaningful?
It is. NIM expansion in this rate environment signals that the bank is repricing its loan book faster than its deposit costs are rising. That's the key indicator of NII health for any bank.
And on the bottom line?
Net income was $227.4 million, the fifth consecutive quarterly record. Pre-tax, pre-provision income hit a record $330.5 million. Diluted EPS of $3.22 beat the $2.96 consensus by 26 cents or 8.8%.
What does the balance sheet look like?
Big picture, total assets are $72.6 billion. The loan portfolio is approximately $46 billion, and deposits are approximately $58 billion. Total equity is $7.38 billion. Importantly, loans grew by $1 billion in Q1, and deposits grew by $1.2 billion, organic growth without acquisitions, which is a strong sign.
How's credit quality?
Very well controlled. Net charge-offs were only 14 basis points annualized in Q1, which is well below the industry average. The non-performing asset ratio sits at 0.34%. No credit quality deterioration despite the macro uncertainty. That's a big positive.
Cash flow?
Q4 2025 operating cash flow was $251.7 million. Q1 2026 will be filed in coming weeks, but based on net income and depreciation, we estimate around $250 million in operating cash flow. Trailing 12-month FCF is approximately $912 million.
On the capital return side?
Wintrust pays $1.05 per share in annual dividends, a 0.71% yield at current prices. The payout ratio is only about 20%, which means there's significant dry powder for dividend growth or share buybacks. In fact, a modest buyback program was active in Q3 2025 when they repurchased $412 million worth of shares. Overall, Wintrust's financial health is solid. NII and EPS are growing consistently, credit quality is clean, and the capital position supports continued balance sheet expansion. The only caution is the modest sequential NII dip, worth monitoring to ensure Q2 resumes the upward trend.
How's Wall Street feeling about Wintrust?
Pretty well aligned with the bullish thesis. 14 analysts cover the stock. 11 have buy or outperform ratings, 3 have hold, 0 sells. The average price target is $163.77 against a current price of $148.79. That's about 10% implied upside before any multiple expansion.
What are the notable calls?
Barclays has the highest target on the street at $185. Analyst Jared Shaw raised it in January 2026 ahead of Q4 earnings, building the bull case around NIM expansion. TD Cowen raised to $177 from $170 in January following the Q4 beat. On the other end, Truist cut its target from $170 to $150 in March 2026. Analyst Brandon King cited a sector-wide valuation reset, not a fundamental concern, but still maintained his buy rating.
So even the cautious revisions are still buy-rated.
Exactly. The Q4 2025 earnings triggered a wave of target raises in January. Q1 2026 results, reported April 20th, will likely trigger another round. The EPS beat of 8.8% is the kind of number that moves estimates higher.
And the Q1 report, how did it land versus expectations?
EPS of $3.22 against $2.96 estimated, that's a beat. Revenue of $713.2 million against a $707 million estimate, also a beat, though modest. The real headline is 5 consecutive quarters of record net income. The stock was up sharply on the day of the report.
Let's lay out both sides. I'll take the bull case. The bull case for Wintrust is a story of compounding consistency. This bank has grown NII every quarter for the past year, hitting 10% year-over-year improvement, while most regional banks are struggling to hold steady. The community banking model is genuinely difficult to replicate. $1 billion in quarterly loan growth and $1.2 billion in deposit growth organically in a single quarter tells you the franchise is healthy. The valuation is genuinely cheap for what you're getting. At 12 times earnings and 1.37 times book value, you're paying below the Graham number for a bank with an impeccable 5-quarter record of increasing earnings. If macro conditions stabilize, the net interest margin has room to expand further, and the 20% payout ratio means significant capital return capacity that hasn't been fully deployed.
Okay, the bear case. And I'll be direct about the risks because I think a few of them are real. First, the NII trajectory. Yes, it's up 10% year over year, but Q1 2026 NII of $579 million was actually down from Q4 2025's $583.9 million. That sequential dip could be a one-quarter blip, or it could be the beginning of margin pressure if deposit costs continue rising while loan yields plateau. Banks that appear to be in NII peak territory don't always recover the multiple. Second, geographic concentration. Over 85% of Wintrust's deposits come from the Chicago metropolitan area. Chicago's economy is large and diverse, but any localized stress, a commercial real estate correction, a major employer pullback, hits Wintrust harder than it would hit a more geographically diversified bank. Third, the dividend. Wintrust yields only 0.71%, well below the 2.7% to 3.1% offered by its peers. Investors who own banks for income have little reason to choose WTFC over a First Horizon or a Citizens Financial.
Those are fair tensions. The sequential NII question in particular is something I'd be watching closely in Q2. How does Wintrust stack up against the competition?
I'll compare 3 peers. Citizens Financial Group is the largest, $27.9 billion market cap, PE of 16.8 times, PB of 0.93. It's cheaper on book value than Wintrust, but more expensive on earnings. CFG also yields 2.82%, 4 times Wintrust's yield. First Horizon is the most similar in size, $11.8 billion market cap, PE of 13 times, PB of 1.35, almost identical PB to Wintrust, but a 2.72% dividend yield. If income is your priority, First Horizon is clearly the comparison winner. Cullen/Frost is the premium valuation in the group, $9.1 billion market cap, PE of 14.5, PB of 2.04. That 49% premium to Wintrust's book value reflects the Texas franchise's exceptional deposit quality and the growth dynamics of the Texas market. Cullen/Frost also yields 2.79%.
So Wintrust is the cheapest on earnings and competitive on book value, but it's the clear outlier on dividend yield.
That's the right summary. If you want the most earnings upside at the lowest valuation, Wintrust makes the argument. If you want income, the peers are more competitive.
What's the options market signaling?
Implied volatility is running at 32.3%, which sits at the 74th percentile of Wintrust's one-year IV range. The IV rank is 23.4%. So options premiums are elevated relative to the recent past, but well below peak stress levels. The market was pricing in a meaningful earnings move heading into the April 20th report.
Any notable positioning?
The data doesn't show unusual concentrated positioning on either side, but elevated IV heading into earnings is standard for banks that have been consistently beating. Options sellers were writing premium, buyers were hedging the report. The actual EPS beat would have compressed volatility expectations on the open.
Always worth noting for anyone playing this with options. A beat often burns the put buyers while call holders celebrate.
And for premium sellers, high IV heading into earnings is exactly the window they target. With the report behind us, IV will likely reset lower in the near term.
Anything notable on the insider side?
Moderate activity. Vice Chairman David Dykstra picked up 164 shares at $127.91 back in November 2025, a modest buy when the stock was lower. Then in January 2026, he sold 1,670 shares at $146.20. That's a 14% gain in 2 months. Not a bearish signal, just standard profit taking after a post-earnings price move. Several directors also received routine stock compensation grants at $139.82 per share in early 2026.
So not alarming either way.
Right? The buy-sell pattern here reflects compensation lifecycle dynamics, lockup expirations, tax planning, rather than any signal about future earnings direction. The net count is roughly neutral.
What are the key risk factors investors need to monitor?
5 main ones. Net interest margin is the paramount watch point, specifically whether Q1's sequential dip in NII from $583.99 million to $579 million becomes a trend. One quarter could be calendar effects, 2 quarters would be a signal. Commercial real estate exposure in the Chicago market is the second risk. CRE stress has been a concern across regional banking, and Wintrust's concentration there warrants attention during the commercial real estate cycle.
What about credit quality specifically?
So far clean. Net charge-offs at 14 basis points annualized and a 0.34% non-performing asset ratio are both healthy. But that's a lagging indicator. You often don't see credit deterioration until 12 to 18 months after the macro stress begins. The geographic concentration risk is real but well understood. Chicago is a large, diversified economy, but Wintrust would be more resilient with more geographic diversification. The Florida expansion is a step in that direction.
And for the Catalyst Watch, what are we tracking?
3 things. NII trajectory in Q2 2026. Loan growth continuing above $800 million per quarter. And any M&A announcements. Wintrust has a history of bolt-on acquisitions. A well-priced deal in an adjacent market could be a positive catalyst for the growth story.
All right, let's bring it all together.
Wintrust Financial is doing exactly what it promises. 5 consecutive quarters of record net income, NII up 10% year over year, net interest margin expanding, loan and deposit growth robust at $1 billion and $1.2 billion respectively in a single quarter, credit quality pristine at 14 basis points charge-offs.
And the valuation?
Genuinely reasonable. At 12 times earnings and 1.37 times book below the Graham number, you're paying a fair price for a consistent compounder. The risk-adjusted case is compelling, provided NII resumes its upward trend in Q2. If that sequential dip was a blip, this stock has further to run.
The key metric to watch.
Net interest margin. Specifically, whether Q2 2026 NII recovers above the Q4 2025 peak of $583.9 million. If it does, the bull thesis is intact. If NII stalls below $580 million for a second consecutive quarter, the rate sensitivity risk is real.
We'll leave you with this. It's not a direct Wintrust quote, but it captures the company's philosophy perfectly. The secret to banking is making friends in the community and keeping them as customers for life. That's Wintrust in a sentence. 173 community banks, 1 balance sheet, and a model that's been delivering record income 5 quarters running.
The consistency is hard to argue with, and in a sector where consistency is rare, that's what the franchise is worth.
And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. And real quick, if this Wintrust breakdown helped you see something you would have missed, we're doing this for every major earnings report. Hundreds of Russell 1000 deep dives, new episodes every week during earnings season. Subscribe and you'll get one of these for every stock on your watch list. Takes 2 seconds and you won't miss the next one. That's going to do it for our Q1 2026 earnings deep dive here on Charged Alpha. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo. That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.